Here is something that happens to a lot of people around the world. You open your phone in the morning, and somewhere in your news feed, there's a headline: the stock market just hit a record high, investors are celebrating, analysts are smiling, and you feel nothing, or maybe something worse than nothing. A quiet frustration you can't quite put into words because your electricity bill went up last month. The cost of feeding your family is higher than it was 2 years ago. You're working just as hard, maybe harder, and yet the distance between where you are and where you want to be financially doesn't seem to be closing. So how is the economy doing? Great. If your economy doesn't feel great, that question is not naive. It is actually one of the most important financial questions you can ask, and today, I want to answer it clearly and honestly. No complicated jargon, no political agenda. Just the mechanics of how this system actually works and what it means for you personally. My name is Nextgen Money, and this channel is about understanding money the way it actually behaves, not the way it's marketed to us. Let's get into it. Part 1. The stock market is not the economy. The first thing to understand is this: the stock market and the economy are not the same thing. They are related, but they measure very different realities. The economy, in the broadest sense, is the total activity of people working, producing, buying, and selling. It includes your salary, your rent, the price of food, the availability of jobs. It is the lived, daily financial experience of ordinary people. The stock market, on the other hand, is a measure of something much narrower. It measures the expected future profitability of a specific group of companies, the ones large enough to be publicly listed. That's it. Here is why this distinction matters. A company can become more profitable while simultaneously paying its workers less, reducing staff, or raising prices on its products. In fact, cutting costs, including the cost of labor, is one of the most direct ways a company increases its profit margin. When that happens, the company looks better on paper. Its stock price may rise. The market goes up at the exact same moment. The workers at that company, and the customers buying its products, may be financially worse off. These are not contradictory outcomes. They are frequently two sides of the same decision. This is why in many countries over the past 2 decades, you can find periods where stock markets delivered strong returns while real wages adjusted for the actual cost of living, barely moved at all. Same economy, completely different experiences. It depends entirely on which side of the transaction you sit on. Part 2. Who actually owns the stock market? Now let's talk about ownership, because this is the number that puts everything else into context. In most countries where stock market data is available, the pattern is remarkably consistent. The wealthiest 10% of households own the overwhelming majority of all stocks and shares, typically between 80% and 90% of the total. In some countries, the concentration is even higher. What this means in practice is straightforward. When the market rises by, say, 20% in a year, the vast majority of that gain flows to a very small group of people. The headline says it was a great year for the market. What it means in concrete terms is that it was a great year for the people who were already ahead. For the rest of the population, the people who do not own significant investments, a rising market is mostly a news story. It is a green number on a screen that does not translate into anything tangible in their household budget. This is not a coincidence. It is a direct reflection of who owns what. And how did ownership become this concentrated? It didn't happen overnight. It happened gradually, through decades of policy decisions, corporate behavior, and a financial system that, whether by design or by default, made it significantly easier to accumulate assets if you already had assets to begin with. Part 3. How monetary policy works against you if you own nothing. Here is a mechanism that rarely gets explained to ordinary people, but it shapes the financial world more than almost anything else. When a country's central bank, the institution that controls interest rates, lowers those rates or pumps money into the financial system. It makes borrowing cheaper. Cheap borrowing flows into assets. Stocks go up, property prices go up, private investments go up. This is not a side effect, it is the intended outcome. The reasoning goes like this: when asset prices rise, people who own assets feel wealthier. When people feel wealthier, they spend more. More spending stimulates the economy. This is called the wealth effect, and it is an official part of how monetary policy is designed to work. But notice what this assumes. It assumes that a significant portion of the population owns assets in the first place. If you do own assets, investments, property, a stock portfolio, low interest rates make you wealthier. The policy works exactly as described. If you do not own assets, the picture is different. Lower interest rates mean the returns on your savings account drop. Meanwhile, the things you want to buy are home, access to investment opportunities, become more expensive because cheap money is flowing into them and driving up prices. The policy designed to stimulate the broad economy does so primarily by enriching people who are already ahead, while simultaneously raising the price of entry for everyone else. This is not a conspiracy, it is a structural feature, and the people designing these policies generally understand it. They make a judgment that the overall stimulus benefits outweigh the distributional costs. You can agree or disagree with that judgment, but you should know it is the judgment being made. Part 4. A Tale of Two Starting Points. Let me make this concrete with two people. Call them Amora and David. Same city, same age, similar jobs and incomes throughout their working lives. Amora's family owned property. When she was in her mid-20s, her parents were able to help her with a deposit on her first home. She never had to pause her pension contributions because she had a financial buffer during difficult times. When markets fell during an economic crisis, she stayed invested. Her contributions kept buying at lower prices. By her late 30s, she has significant home equity, a growing retirement fund, and a net worth that has been quietly compounding for over a decade. David's family rented. He graduated with student loan debt that consumed a significant portion of his early income. He had to pause his pension contributions for several years while managing that debt. When markets fell, he had very little invested, and what he did have, he moved to cash out of fear, and missed the recovery that followed. By his late 30s, his retirement savings are modest. He has no property equity, and the gap between his financial position and Amora's has grown wider every year, not because of any difference in effort or discipline, but because of where they each started. The market went up for both of them. It just meant something entirely different based on their starting position. Part 5. The mathematics of the head start. This is the part of the conversation that most people have never had explicitly, and it changes how you see everything. Imagine two households. One has the equivalent of $100,000 invested, the other has $2,000. Both invest in the same index, earning the same percentage return, let's say 8% per year. At the end of year 1, the first household earned $8,000 without doing a single thing. The second household earned $160. The percentage return was identical. The outcome in real money was not even close. Now run that forward 20 years without any additional contributions. The first household's $100,000 becomes approximately $466,000. The second household's $2,000 becomes approximately $9,300. Same market, same decisions, same percentage returns. The gap in absolute terms did not stay the same, it got dramatically wider. This is the mathematics of the head start. It requires no bad decisions from the person behind, and no exceptional skill from the person ahead. It simply runs, automatically, every year. This is also what generational wealth actually means. When you strip away the cultural mythology, it is not primarily about dramatic inheritances. It is about the compounding advantage that a moderate financial head start creates over decades, an advantage that grows larger with time, not smaller. Part 6. The buyback mechanism. There is one more piece of the machine worth understanding: stock buybacks. Over the past few decades, it has become common practice for large publicly listed companies to spend billions purchasing their own shares on the open market. When a company does this, the total number of shares in existence decreases. Here is why that matters. A company's earnings per share is calculated by dividing total profit by total number of shares. If the number of shares falls, even if the profit itself stays exactly the same, the earnings per share rises, and when earnings per share rises, the stock price typically follows. This means a company can engineer an improvement in its stock price without actually growing its business, hiring more people, raising wages, or creating any new economic value. It is entirely legal, and it has become one of the primary drivers of stock market performance in many countries. For the shareholders, particularly the largest ones who hold the most stock, this is genuinely good news. For the workers at that company whose wages were held flat because the budget was being used for buybacks, the rising stock price creates no direct benefit. Same company, same year, completely different relationship to the outcome. Part 7. The locked door problem. Let's return to ownership one more time, because there's a layer that most conversations about investing miss. Even among people who do have some exposure to the stock market, through a pension, a retirement account, or a small investment, the nature of that exposure is very different from how wealthy investors hold their assets. For most ordinary people, market exposure comes through retirement or pension accounts that are locked away until a specific age. You typically cannot access that money without significant penalties. You cannot use it as a deposit on a home. You cannot deploy it when a business opportunity arises. You cannot liquidate it in an emergency without losing a large portion to taxes and penalties. The wealthiest households, by contrast, hold a significant portion of their investments in unrestricted accounts they can move, deploy, and capitalize on exactly the moments of market volatility that the locked account holder must simply ride out with no meaningful choice. Same market, completely different relationship to it. Part 8. What to actually do about it. So where does this leave you? First, let's be clear, the stock market going up is not evidence that your personal financial situation should be improving. These are two different measurements. Conflating them serves people who want you to feel like you're missing out on something you're simply too undisciplined to access, rather than understanding that the game has structural barriers that have nothing to do with your behavior. Second, if you are not yet meaningfully invested, if most or all of your income is spoken for before you can set anything aside, the most important financial priority is not optimizing an investment strategy. It is building a small cash buffer and eliminating high-interest debt. Here is why. If you carry high-interest debt, a credit card at 20% interest, for example, you are guaranteed to lose 20% on every naira, pound, dollar, or shilling sitting in that debt. No investment reliably returns 20% per year. Paying off that debt is the highest guaranteed return available to you. That comes first. Third, if you are investing, even a little, the most expensive mistake you can make is reacting to fear. The data on this is consistent across markets and decades. The gap between what the market returns and what the average investor actually earns is largely explained by people selling during downturns and buying back in after the recovery, missing the best days in the process. Markets tend to rise over time, but that rise happens in unpredictable bursts. The only way to capture those bursts is to be invested when they happen, which is usually when the news is frightening and your instinct is to exit. Finally, if you feel like you are nowhere near the starting point of this conversation, if investing feels like a distant concept, not a current reality, then the most important reframe is this: the disconnect you feel between headlines about record markets and the reality of your own financial life is not a perception error. It is an accurate reading of a system where the benefits of market growth are distributed in close proportion to existing ownership. Your frustration is a rational response to real mathematics, not a personal failing. Understanding that clearly is the beginning of addressing it, not by trying to time the market or find a shortcut, but by methodically closing the distance between your current position and the point where your money can start working alongside you, rather than leaving you entirely on the outside looking in. The stock market will keep hitting new highs, headlines will keep announcing it, and for the people with significant ownership, those headlines will translate into something real for everyone else. The question is not whether to feel good about a number on a screen. The question is, what is the one concrete step you can take today that moves you closer to meaningful participation? It is rarely glamorous. It usually involves clearing debt, building a small buffer, and then beginning, even imperfectly, even slowly, to put a consistent amount into a low-cost, diversified investment that you leave alone. That's the foundation. It's not exciting, it works, and the earlier you understand why the system is structured the way it is, the better positioned you are to navigate it on your own terms. If this was useful, subscribe and share it with someone who needs to hear it. I'll see you in the next one.